There is a comment that came in related to the married puts. Hemant says there are some options that have 0% risk. Well, there's no trade. There's structures of trades that look that way, Hemant. But I found in trading, in reality, that's not really what they are. Can I get a married put with as little risk as possible? Yes. So let's go to search by symbol in our married put tool. I'll use Apache again because we've been playing around with it. Let's just go out 182 days to April. I'm going to select all results. Now, Apache remembers trading around 43, 43.20. This isn't as good as I want. Let me find something that's been depressed recently. I don't want to use Peloton. That's ridiculous. What was the one? Was it BX? Ernie's in one called BX. Let me see if this is the one I'm thinking of. Yeah, this is close, but not. Oh, yeah, there's some in here. So you can see here that these risks are at 1.2%, a much lower risk than I was looking at, and it's still 140 days out in time. But in this case, I'd be buying the stock at 85.43, and I'm buying a 150 put, which is 75% in the money for a cost of 65.50. Well, total net debit's 151.88, and the max risk is only 188. And the thought is here, well, okay, at midpoint, it's 0.6%, so it's almost no risk. But now what happens is the probability of profit is so small. You need the stock to be trading up near 105, 110 at the halfway point just to start seeing a profit. That's a big expected move for this position. And at expiration, you need the stock to be above 150 if you held it all the way into that position. And that's going to give you something that had a large gain from where you bought into the stock, but because of the high price of the put, because you did the improper structure, you went too deep in the money looking for too low of a risk. There is such a thing as too little risk when you open a position of this structure. And that's what we're looking at in this case. The expectancy of potential profit is so small. And the comment comes in, well, you could just sell a call for $1 against it. Where's that call going to be? 87.50? 90? My cost basis in the total trade is still 150.93. An improper use of that income method number one, selling a call against the trade, is to sell a call below the put strike price. See, this here is 270. This covers all of that risk. Well, to the downside. But what did I just do? By selling an 87 strike call against this married put structure that had a cost basis of around 150 or 150 per share, I should say, or $15,000, I've increased the risk to 41.2%, not to the downside, but to the upside in the original direction I thought the stock was going to go. Sure, I'm not expecting the stock to go up to 110, 120, or 130, but even if it moves up the 5 or 6% I was looking for initially, up to 90 maybe, 91, 92, I'm at a loss on the position. That's an improper structure. Yes, you reduced the loss to the downside, but you've more than tripled, quadrupled the risk to the upside in the direction you initially thought the stock was going to go. Because remember, married put is a bullish position. The income methods help us in different market conditions, but it's bullish. We want the stock to move up, which is why we got into it. Using the improper structure, taking too little of a risk and trying to sell short-term calls against it to have a quote-unquote bulletproof trade right away is not the proper approach, because you got into this position initially thinking the stock was going to move up 3 to 6% in the next 20 to 40 days. Now you've put yourself in a structure, if that comes to fruition, you're losing on the position and not making money. All right, so Hemant went on to say, it's not really what I was talking about, but it's always a good example to review that. Hemant says, I have TQQQ, which I bought at 20.98. And I'm sorry, I got to add the stock in there. And I bought the 40 put at 19.14 for December 16th. Yeah, this goes beyond what we would normally look for. It's too deep in the money for what we want to see. You bought it at 19.14. So now your total cost basis in this position between now and December expiration is about $40. And you've got the 40 strike put. Okay, you didn't mention a call there. That's fine, Hemant. Total cost is $40.11, okay? And so you've got a 0.3% risk on the position. $11 is what he was referring to. I'm sorry, you said 1,100. You have 1,000 shares, so I'm sorry about that. So you're risking only 0.3%. If the stock TQQQ goes up to 26, 27, or 28, halfway between now and December expiration, you might be seeing a small profit, $18, $12, okay, $1,800. But if you get closer to December expiration, you need TQQQ to be above 40 to profit. And that's what I was talking about, it being too deep in the money. You're 100% or close to 100% in the money. So the expectancy of expected profit is very small. Do you have a low risk, Hemant, or almost zero risk? Yes, I'm not arguing that. Could you take the risk of selling calls at these lower strike prices to further bulletproof that? Yes, but it's going to come with the same risk I just mentioned. I'm going to give a lot of room here. Let's just go 3 times. Let's go to the 25 call. Yes, I know. The reason you got it to TQQQ is because it could really take off. I understand that. But the risk of selling a call if TQQ really takes off, same thing we just illustrated on that previous example. If it catches you unawares and it gaps up too quickly, you're going to be a loss on the position by having sold that call. Do you currently have a almost no risk trade? Yes, you do. I can't argue the math. I can't argue the numbers about it. And that's not what I'm arguing. What I'm saying now is the expectancy of a reasonable potential profit. The expectancy of that potential profit is so low percentage-wise, especially as we start getting closer and closer to December expiration, because you need it in that sense. Okay? That's what we need to see, Hemant. All right. You say, yeah, that makes sense. Okay, great. Bruce says, are there bearish trades in the blueprint? Well, the blueprint, again, it discusses that initial married put structure and everything that we do off of that initial married put structure and different market conditions. Now, I'm going to sign in as me. Oh, you're not seeing it. Good. Okay. Sign in as me. And one of the other things that blueprint owners get, Bruce, is the members only content. And these are webinars we put together for blueprint owners or even the Fusion subscribers. You know, ideas on income method 4 and income method number 1 and 6. Is it time for income method number 9? Q&A, put your blueprint to work. But where I wanted to go here is there's a members only webinar that I either just passed or I'm in the wrong section. I think I'm in the wrong section. Oh, no, it's right there in front of me, Bruce. Playing the bear side of the market. And blueprint, and it doesn't mean that we're showing bearish strategies. We have bearish strategies on power options, education on bear call, credit spreads, bear put, debit spreads, and so forth. But this is our approach. Instead of setting up a married put structure, which is bullish in nature, is setting it up to a bearish position from the start with low risk. And that might be as simple, something that I do occasionally, Bruce, in bearish markets, is doing a standard married put on an inverse ETF or 2x inverse ETF. 2X's usually work better in this case. I did a married put on SH once, and it just sat there. It moved down as the market moved down gradually, but it moved down so little. It was only 4 or 5%. So that case there, you see Kurt and my thoughts on playing the bear side of the market, what to even do with a married put as the market goes bearish, but also how to set up a structure for the bearish direction in that case as well. So that's the starting point you want. That's available for Blueprint owners and Fusion subscribers at Radioactive Trading when you log on to your members only account using the same password you use for Power Options as well. The discussion here of the 12 different income methods, everything that's discussed in the Blueprint is done off of that basic structure of the married put. It is the proper blueprint for protective, conservative options trading strategies. Low risk with ability to get income, having the upside open in most cases. However, all 12 income methods relate to doing it inside this structure. The blueprint does not go through 12 different option strategies. It does, in a sense, but in the context of the married put. Income method number 1 is a covered call. but selling a call against the context of married put. Income method number 6 is a bear call credit spread, done in the context of this married put, a nested trade inside the married put position. So that's what we're talking about there. That's what the blueprint is. It's all the 12 adjustments we would use inside the structure of the married put to begin with. And sometimes that structure might change. If I am in a bearish market, Bruce, going back to you, if I am in a bearish market, I didn't do it. There's one I really should have done it on. It wasn't Starbucks. It was the one before that. Was AIG earlier this year. If we think we're having a turn, one case we might do is we're in a married put is just sell to close the stock if we're taking a small loss of 1 or 2% on it and just leave the put open. Let it run and then restructure the trade if we think we've hit a bottom, it's going to go back up. I typically use income method number 12 in that scenario as opposed to selling the stock and letting the put run, but to each his own. In this case, I have a few radioactive traders that do just sell to close the stock, leave the put open, and then when they've gotten the profit level they want, they'll adjust the put and buy back the stock, thinking there's going to be a recovery or going to move back up in price. So that's what I'm saying, that the one case or so there might not be a real quote unquote married put structure, but it's all based on trading this as a married put continuously.